It was a very interesting week that basically started with the collapse of Made, the British furniture online company, a pretty big one, stock market listed. And then a little bit later, the news came in that FTX, the second largest crypto exchange, would not be bought and bailed out by Binance, but instead would collapse and basically have no way to literally solve their liquidity issues. And that was kind of like a shock in the crypto world. So what can we learn from this? Well, the first thing is that somehow herds of people always seem to fall for the same thing time and again on financial markets. And that's kind of shocking, because every time it happens, people think that it's an enormous surprise and that they would not be so foolish as to fall for it, and that it's only their neighbors. But then everybody has a hell of a lot of neighbors. So what I took from this is that the feeling was basically, have the lessons by Nobel Prize laureate Harry Markowitz, have they been forgotten? Harry won the Nobel Prize in 1990 for the work that he did on modern portfolio theory, and every student of economics, finance, investments all over the world, they all heard about it. And somehow, if people would be practicing it with some kind of level of seriousness, all these things would be less shocking than they actually are whenever they happen. Maybe I'm biased a little bit because I happen to be one of the few lucky people who worked for 10 years with Harry. So maybe I got a little bit more of the Harry sauce. But let me explain why it was so shocking. These two, totally different, by the way, collapses. The first one, Made.com, UK-based design furniture online platform, where basically the idea was very simple. Before the whole world would buy everything, including design furniture in China, why not create a platform in the UK where people from the UK could buy their own design in the UK, knowing that then the design, the taste, etc., would all be totally in line with what people in the UK would be looking for. They quickly rose to fame, with international customers becoming more and more important. And when they went to the stock market in June 2021, the introduction was at a price of 775 million British pounds. So quite an achievement, because the firm was only 10 years young at that time. And then, even more of an achievement if you ask me, 1.5 years later, total collapse with a final value of just a couple of millions. And of this couple of millions, if you know that Next, the other British large department store, bought the website and the whole set of customer information for a little bit more than a couple of millions, then basically it means that all that was left of this once so proud stock market introduction was literally Made.com, the website. So that was quite a shock. But this was yesterday basically a small shock, because the news came also in that FTX, the second largest crypto exchange, which was founded in 2019, and which wasn't even at the stock exchange, because in 2022, February, they just did their Series C financing with a value of 32 billion. Not stock market listed, and already 32 billion in Series C. Was out of business. End of story. And I added there the stock price information for November 7 and November 8. And as you can see, how did that go in the final stages, which was already at a much lower level than what the company previously saw for its token. This is not the company, this is the token, because the company is not listed. You can see how strange that went. So in the beginning, you saw that the price was kind of lingering between, let's say, 15 and 22.5. And then, as the indication there says, it went down a little bit, and there were a few suckers who were still buying, so the price went up from 15 to 20, which is quite a bit, a 30% increase. So those people are not that happy buying the coin then. But people always seem to do the same thing. Then it went down from 20 to 5 within a couple of hours, and then it doubled again. So there's always people who think, well, it cannot be as bad as people say it is, and then they start buying and the speculation begins again, and everybody falls in love with the upticks. And that's the problem. There's a behavioral problem in the whole concept of financial markets, and I try to explain it a little bit. What's the basic cause of all of this? Well, you know why? The problem is, if you go bankrupt, you lose 100% of your value. But to the upside, the sky is the limit. So if you're playing a game where you can never lose more than 100%, and on the other side you can win far, far, far more than 100%, you think, hey, this is the kind of game that I want to be in. And that's not true. If you know a little bit of math, you will know why that is not true, but let's go through it. The first thing we can learn from this is that there is one gigantic problem that people seem to be suffering from in financial markets, and that probably is something that you also see elsewhere, and that's the fear of missing out. You have your friends, and the friends are doing well, and the friends tell you should do it as well, and everybody does have such kind of friends that give them information about what went well. But the problem with those kind of friends is they always give you the information of what went well, and just a few friends will tell you what went totally wrong. And then you might probably think, how stupid can they be? I'm not like that. So you want to follow them when they do something good, because you don't want to be the loser who forgot to follow them. And the other way around, when they do something bad, you will say, that's not me anyway. So this fear of missing out is a very tricky killer. The second thing, and that's something people seem to be forgetting in financial markets all the time, what seems too good to be true normally is too good to be true. And you will see that in these two events very clearly. The third thing, and that's something basically referring back to the math that people get in school. Everybody already as a kid, in primary and secondary school to a certain extent, but definitely in high school, people don't understand percentages and how they work. And the problem is also people who fall in love with markets and who have this fear of missing out, they also fall in love with the more volatile asset classes. And you see already that kind of risk in the following example. If something drops from 100 to 90, that's just a 10% move downward. And if I then have to move back to 100 to recover, I need an 11.1% increase just to be back on this 100. So you already see that the losing part, 10%, is smaller than the gaining part, 11, and still I didn't do anything. I'm back at my 100. Now, suppose I have something that can drop 50%, from 100 to 50. Then I need a 100% increase to make up for the 50. So whereas the difference between down and up is only 1.1%, or basically in percentage terms, because I'm lying, it's percentage point 1.1. In percentage point, it's 11.1%, and here you can see it's double 50 to 100 when the drop is bigger. So basically this means that the bigger the drop and the more volatile the asset class, the larger the price swings should be, not to make more profit, but just to recover from former drops. And that's also a very important phenomenon that's playing a role here. But I hear you say, Made.com is a very small British company. I have never heard of them. If you're outside of the UK, probably. And otherwise, you would say, come on, this is not like Apple. This is not like Saudi Aramco. This is not like IBM. This is just a 700-something million company. And the crypto thing, crypto, but hey, this is the crypto exchange. This is not the coins. What about Bitcoin? Because in crypto, I only do Bitcoin because that's really the large cap, the powerhouse in the crypto market. So what I did is say, okay, if Bitcoin is the powerhouse, so then let's now analyze what happened this week with Bitcoin to see if one or the other way their investors felt what was going on with the other things. And the conclusion is very simple. When panic strikes, everything suffers, and especially those asset classes that are dominated by smaller, non-diversified investors. This is just a screenshot from yesterday evening of the 20 largest cryptos in the world. A couple of things that you can see. There's an enormous amount of things red. The last 24-hour column is almost totally red. The 7-day column is almost totally red. The 30-day column is almost totally red. And the year-to-date is totally red. And actually year to date, as you can see, it's a minus 55% return, which for the average stock market investor would be something like 2 times a stock market crash. And you literally see there that it's a disaster, even for something stable as Bitcoin, which by itself is more or less, together with Ethereum, the whole market, if you want to exaggerate a little bit, 309 billion reported market cap for Bitcoin and 139 for Ethereum. So together these two are more than half of the total market cap of the top 20, which is 820 billion. But also keep in mind, 820 billion may sound like a lot, but on the stock market, we have companies that are bigger than the top 20 of the crypto. So crypto is still a small segment of financial markets, but one that was hammered like crazy. Not just the 2 companies that went bankrupt are in a way suffering, but the whole market. And this is obviously far more related to the exchange, FTX, than to this Made.com. But the mindset of small investors at the moment is one full of disappointment. Inflation, Ukraine-Russia conflict, where do we go with the economy? What's the government doing to bail me out with the high energy prices, etc., etc. So whenever the mindset of people is that of disappointment, then be very, very, very careful. And here you see the Bitcoin history since 2011. So basically you see nobody was talking or thinking about Bitcoin in this period 2011 to 2017, not much going on. Then 2017, 2018, you see an increase, and then it's kind of stable. And then all of a sudden 2020, 21, you see the increase where basically you could say we go from in 2018, 16,000 all the way up to $65,000. And now in a very short time fall back to the same 16,000. So everything gone that was built in 4 years time. So in a way, even with Bitcoin, the big one, you could say, after the glory years, now the sudden fall. Okay, but that could be, you might say, the longer term trend, and we see that in every crypto. So then let's go back to the last week. Do we see somewhere that Bitcoin, that was already hammered in the past, is suffering in this last week with this FTX information coming out, with maybe British investors one or the other way affected by this Made.com stuff? And you can see that the answer is yes. So if you look at this week, you can see towards the end that even now at the already low price for Bitcoin, we are not even near the 65, we're closer to the 16. Yeah, we came from 2021 in this week. So we went down another 25% to get to this 16 that we saw at the end. So even in the last week, you can very clearly see that the powerhouse crypto, where there's a lot of small investors in there, is terribly affected. Then let's do a little bit of math. Investors tend to overestimate themselves and their possibilities simply because they don't get the math right. Percentages is the problem here. So let's take the Bitcoin example. 2018, we started 16,000, then 2021, as we saw, 65,000. That's an increase of 306%. That's fantastic. And in the year 2022, in 11-month time, we go back to 16, but that's minus 75. So if you were the dude who was doing Bitcoin all the time and talking to your friends in the back of their mind know, oh yeah, that's the guy that made 306% in the last 3 years. So if you would then say, yeah, I lost 75%, and they still have in their mindset, oh yeah, he made 306 and then lost 75, they might in their mind think, oh yeah, that's the guy that made 230%. You didn't. You made nothing. So this minus 75% totally washes away in a short time the plus 306. And maybe now some people start to understand why those freaky academics in finance always use logarithmics. Why do they do that? Well, here you see why they do that. Because if you would calculate returns using ln, the logarithm, which basically on your Excel is ln and then the number that you calculate, and then whenever you want to calculate a percentage return, you simply take the difference. You can see that with logarithms, exactly this thing is avoided. The plus from 16,000 to 65,000 is the same percentage as the minus is. So literally, there is no way with its logarithmic returns that you can fall for this trap that a lot of people seem to fall for when thinking in terms of percentages. And because FTX was not listed on any exchange, they were basically still in their private equity stage, a second math trap that also explains why people have this tendency to fall for this shit. Take a venture capital fund with 10 companies in the portfolio. Maybe the venture capital fund that in the Series C was investing in FTX. Suppose they have like 10 companies and 9 of them end in failure, bankruptcy. Okay, that's minus 9 times 100%, you say. But they have one unicorn and they made 10,000% on it. Wow, that's fantastic. Because if you think of this venture capital fund, you might think that they made 910% on the portfolio. Cool, huh? 910% plus this fund. Well, now don't talk with your fellow investors or with the VC guy himself. No, start talking with the investees, the companies in the portfolio. Then the first 9 founders will tell you, these guys suck. My company totally destroyed. And number 10 will say, fantastic, these guys are great. So the moment you talk to the investees, 9 out of 10 are dead and have a very, very bad story about the guy. And one says he's the best in the world. So most investors start with a horny percentage mindset. They want to believe that the venture capital guy is right and the investors are just, sorry, the investee companies are just nagging. So basically they tend to believe this thing on the left side, not the thing on the right side. So here you can see what the math mindset can already do. So literally, if you want my lesson from what happened this week, it's 4 elements. First, be critical. Not immediately think that what someone is telling you is right, because in financial markets you will all the time meet people that have some kind of thing where they can make money from you acting in a certain way. The second thing, understand what you're doing. Calculate values up front. Don't assume that the price is always right. Very often the price is an exaggeration of the real value. And when trends are up, you know that the fear of missing out will have other people step in and buy because others had to do so. So that the tendency of the price to be too high is very much there. The other way around, and that's also true, when the price goes down and people don't know, there is of course always a chance that the price goes down too fast. And then there might be possibilities to buy. As you saw in this little chart that we showed earlier from the FTX market, where at the end you saw some people buying because they thought that the market went too fast. But that's a very, very risky game. And if you don't understand things very well, never ever play that game. And cryptocurrency, well, be very careful. This is not a currency that you're investing in. It's basically a kind of equity. And then an equity with not that much information available. And to get back to Harry Markowitz, the guy who we started with, the Nobel Prize laureate, diversify, diversify. Don't put all your eggs in too few baskets.
It's excellent. Very interesting. I have a question here, actually. So basically what we started with, we saw
Yes.
the collapses, huh? So these 2 companies seen, these collapses. But then when we try to write kind of a bottom line of the reason of these collapses, can we say that is a bubble thing plus market climate plus psychology of the investors, meaning the FOMO effect and lack of some kind of discipline? Can we summarize it in this kind of ways?
Yes, I think the things all get together. So in a way, if you look at the valuations now and the big disappointment, then obviously part of the disappointment was also that the high numbers that I showed, the IPO number for Make.com and the Series C number for FTX, that probably those values were way too high. So that in the past there were investors who were too optimistic about these companies, paying too much, so that those prices were very, very, very high. Now, normally, if markets would be totally informed and information processing efficient, then literally there would be new information and the prices would drop a little bit and everything would be fine from the moment where basically the price and the value are the same again. Now, the problem with small companies like May.com and an exchange like FTX that's not even on the stock market, with crypto being mysterious anyway, is that when there is not so much information, investors start, basically creating information together. But when none of them knows, the risk is very big that when things are going well, people exaggerate the story in a positive way. But the moment that things start to shift the other way around, downward, then in a way, that badly affected people start talking to others. Oh my God, you know what happened to me? And then that guy starts saying, oh my God, you know what happened to this guy? Basically, and there's the problem again. He's not saying what happened to me because he followed that guy. He's saying what to other people, what happened to that guy, trying to save his face. But in this kind of roller coaster that then starts to happen, what you will see in the end is that there is no way to stop it. Unless, and there we go, unless one or the other way, central banks, big banks, governments, etc., start helping companies. But the funny thing with crypto and anything related to that space, and even sometimes with small online companies, is that those people who invest there seem to dislike governments, seem to dislike regulators. But these kind of moments show why big investors always demand a certain influence of regulators, so as to avoid these kind of things. And so basically, it's like flying with the bad airlines. You can fly with the bad but cheap airlines, and every time that you safely land, you can say, the stupid idiots who pay so much for the expensive airline. But it's not about all the times that go right. It's about this one time that goes wrong when you're dead flying the cheap airlines. So you can compare it with that.
Okay. And if we just may touch a bit on the market efficiency here. So can we say that bubble bursts is actually a sign of market efficiency, or is just a sign of people?
That's a very good one. That's a very good one. See, because in the end, information sooner or later will pop up, and then prices will adjust. Because even if you don't want, the buying and the selling behavior of the investors will go in the direction of the value. So if a price is too high, people will start selling to basically lock in their profit. And because of this selling pressure, the price will move down towards the value. And the other way around, when the value is higher than the price, so some investors have extra information compared to others, and they know that it went down too far, and they start buying, then basically the volume that they create will then pull price back into the direction of the underlying value. But because we cannot and will never be able to really know upfront for sure what the value is, this game between price and value moving back and forth will always be there, and it will never be totally sure. And that's what you said. So an efficient market will basically process all the information and data available, but this game will always go on, and the simple functioning of the market will ensure that this game is in the interest of investors in the long term. However, the less efficient the market is, the longer this mismatch between price and value can last.
Okay, so actually, even though we can create these models for the real valuation, but then the markets will always dictate the pricing by nature. But then basically what you're saying, that on the long term, the real valuation will expose itself, and if there is a bubble, it will burst, and if something is undervalued, it eventually will come to the right pricing.
Yes.
So this leads to the question, basically, when there is a crash, and actually what we are seeing, not only with the MAID and FTX example, and then with the cryptocurrencies, but also with the with everything right is crashing, could then say that this is a nice opportunity to buy right now, if you look at these declines, or it's just for example, if we talk about cryptocurrencies in this case, or MAID in this case, the fact that they dropped so much in just 1 year means that they will continue dropping, or it's a good time to buy?
Well, in these two cases, I think it's end of story, and they're both dead. So you shouldn't step in if you still can, and probably you can't anymore. But in periods where people start spreading rumors about companies not doing so well, and you can still speculate, are these rumors correct or not? Yeah, then obviously there will always be investors saying, this is exaggerated and we can still step in, whereas others say, oh my God, I have to get out. So basically this market mechanism will, as long as you can get in or out, and that's obviously easier for things that have a stock market listing than for companies like FTX, where basically you couldn't get in without being in direct contact with the exchange because they didn't have a listed share. But the game will always continue, and there will always be people who one or the other way are a little bit more optimistic than others. And the problem with a value-based approach, where actually we say you should always do that, you should always calculate your own value. The problem is that people around you have also another nasty tendency. They will share more information with you about their successes and not talk with you about the things that went wrong. And that's another difference between small investors and big investors. When you talk to a big professional investor, be it a pension fund or a venture capital fund, at least you know that these guys, because of the regulator, will have to publish their full results, the things that went well and the things that went wrong. So on average, they always look a little bit less good than, let's say, the small investor who only tells you about the things that went right, but not about the things that went wrong. So in a way, when you are exposed to people around you or financial newspapers that talk big stories about things that went well and not that much about things that went wrong, and you also make this mistake that we addressed here, thinking, a bankruptcy is just minus 100%, and wow, look at this stock went up 10,000%, and you don't correct for that in the logarithmic manner, then the tendency will always be that you are too optimistic and that you underestimate how complicated the investment game really is. The moment you do, and that's the good news, the moment you do understand that it's difficult and that you do properly diversify as opposed to putting all your eggs in one basket, then on average you can make far more than on your savings account, and that's the good news.
Yeah, so that's what you ended up with actually, and that's my question regarding the collapse prevention mechanisms. So basically for the investors, how they can prime themselves to, to make sure that they are collapse proof or crash proof in their portfolio is basically diversifying this portfolio. That's number
Correct.
one rule, right?
Yes.
And then also about the mathematical thinking, what you shown us with the logarithm there is actually very smart approach to seeing how to have this kind of discipline with the help of the math for the holding of the portfolio, and kind of not falling for this fearing of missing out effect. But then how do you make sure as a company, let's take Made and FTX in this example, how do you make sure that you are preparing yourself like to be collapse proof, to prevent the collapse in their case? What measures could they take to prevent this collapse?
Good point. What can you do to avoid, let's start with Made, to avoid bankruptcy? We did not invest ourselves in Made. Why is that? Didn't we like them? Didn't we like the valuation? Well, we like online business models. We like furniture. But it's very simple. Furniture from Europe, making furniture is not really a very complicated task. I mean, don't think that I could do it, but in general, it is something that people can do in many countries in the world. So the moment that you know that workers in Europe don't work so many hours as workers elsewhere and are better paid than workers in, let's say, China and Vietnam, you know upfront that if you go for this business model, you can say, yeah, but the design in Europe is better than in Vietnam or China. But then basically my reply would be, okay, but a big Chinese successful company could hire a designer from Italy or Sweden or wherever, pay the guy $1 million salary, and then he still is a far bigger company that could make cheaper furniture. So basically, whenever you analyze a business model as an outsider, and you can see, can this work? If you can see that as an outsider, the company itself should one or the other way be willing to explain why what they do has a unique selling point and can work all the time. in good times and in bad times. And that's where the problems start. Some companies that are not so experienced think that they can get away with just sharing the good news when things go well, and then be a little bit more silent, not saying anything when things go bad. And yeah, the ones that really are hit by bad periods, that go very deep, if they do nothing, then sooner or later, and that's the beauty of markets, people will know and the information will be shared. So in a way, have a good investor relations department, share information in good times and in bad times. That creates the trust with your investors, and that's the only way. But it's a difficult way, just like how investors like to talk more with their friends about what went well than what went wrong. It's the same thing.
Okay, so basically this is the element that the investors also need to take into account when considering which company or which asset to invest in. So they need to know, okay, what's the unique benefit of it, and where, and with that they can take into account the market climate and where it's going and the trend to find out, okay, whether this a nice option for them to invest in.
Exactly. Yeah. And yeah, think about yourself. If you would tomorrow have to do a presentation for our members, where basically you are going to share your best investment of last year, and then the next day you have to do one where you're going to share your biggest blooper of last year. I'm pretty sure that 99.9% of the people, including you, would like tomorrow's presentation more than the one the day after. And that's psychology is really what's at stake here. People don't like to talk that much about what went wrong. And the problem is that if you don't properly adjust for that fact when playing in financial markets, you will all the time overestimate the potential returns and underestimate the potential risks.
Excellent. I think it's a good wrap up for this first edition of Daily News with our CIO. So thank you so much, Erik.
My pleasure.
Really nice.
Yeah, and if anyone still has a question somewhere in the future when thinking about what this all means for him or her and the portfolio that they are running, feel free to reach out, and we will be more than happy to address those questions.